My name is Skytech-Lens and welcome to our deep dive into a seismic shift in global energy markets. For years, the US was a dominant oil exporter with China as its top customer, a relationship seen as a pillar of global energy stability. But in early 2025, that pillar collapsed. China, amid a new round of tariffs and escalating trade war, abruptly halted all US oil imports. The result? US producers were left reeling, and a multi-billion-dollar trade relationship was shattered overnight. Today, we'll uncover how the US lost its biggest oil customer, the political decisions behind it, and the far-reaching consequences for America's energy future. This is more than a story about oil, it's about power, sovereignty, and the uncertain future of America's energy dominance. The collapse began with China's sweeping 25% tariff on US crude in early 2025, a direct hit, not a warning shot. Overnight, American oil became uncompetitive. Contracts were canceled, tankers rerouted, and billions in infrastructure investments were suddenly at risk. Houston boardrooms went into crisis mode. The assumption that China's demand was unbreakable proved disastrously wrong. The tariffs didn't just pause trade, they triggered a permanent rupture. Chinese refiners rewrote supply chains, erasing the US from their future plans. American producers scrambled to find new buyers, but the trust and market share were gone. The US learned a hard lesson: no customer is guaranteed, and wielding oil as a political weapon can backfire. The collapse of the US-China oil trade was a stark reminder of the limits of economic power in a world of shifting alliances. The world's largest oil producer was suddenly on the outside, looking in. With US oil off the table, China pivoted with stunning speed. State giants Sinopec and PetroChina expanded long-term deals with Russia, making ESPO crude a new staple for Chinese refineries. Simultaneously, China deepened ties with Saudi Arabia, the UAE and Iran, negotiating not just for oil, but for yuan-based contracts. This shift wasn't just about barrels. By paying in yuan, China insulated itself from US financial pressure and sanctions. Refineries were retooled for heavier, sour crudes. Shipping routes, insurance, and contracts were rebuilt around non-American partners. Within months, US crude was replaced, seamlessly. The new map of China's energy imports reflected its geopolitical alliances, not just market logic. The US was now conspicuously absent, a deliberate omission in China's new energy order. The global energy landscape had been redrawn, and China was setting the rules. China's pivot wasn't just about oil, it was a calculated strike at the US dollar's dominance. By insisting on yuan-denominated oil contracts, China built an alternative financial system with Russia, Iran, and Gulf states. For American oil, this was a new barrier. Buying US crude now meant navigating the dollar system and US oversight, while Russian or Saudi oil could be bought directly in yuan. The Shanghai International Energy Exchange's yuan-based oil futures exploded in volume, making the yuan a new benchmark for Asian oil. As more oil traded in yuan, global demand for the currency grew, challenging the dollar's supremacy. For US producers, this shift was more permanent than any tariff. Their product was now structurally incompatible with China's new system. The Dedollarization push was a lasting consequence of the trade war, signaling a multipolar financial future. China had secured both its energy supply and a new level of financial sovereignty. The collapse left billions in US oil infrastructure, pipelines, storage, and export terminals, sitting idle along the Gulf Coast. Built for China's massive appetite, these assets now operated at a fraction of capacity, with revenue streams drying up and bankruptcy looming for some. US producers scrambled to find new buyers, but no single market could replace China's scale. Instead, they turned to a patchwork of smaller, more competitive markets in Europe, Latin America, and Asia, often at steep discounts. Logistical challenges mounted shipments had to be broken up, costs rose, and many refineries weren't optimized for American crude. The underused infrastructure became a symbol of strategic miscalculation, reminding the industry of the risks of over-reliance on a single rival customer. The US energy boom had mastered geology and technology, but not geopolitics. The world's best export machine was left idling, with no easy fix in sight. As economic pain mounted, Washington pushed for new trade talks, hoping to restore oil exports to China. But Beijing had moved on. Chinese negotiators refused to discuss oil, focusing instead on tech and agriculture. For China, the shift away from US oil was permanent, a strategic realignment, not a bargaining chip. Meanwhile, China launched a massive push into electric vehicles, slashing future oil demand and accelerating its energy transition. EVs flooded Chinese streets, shrinking the long-term market for gasoline and imported crude. Even if trade reopened, the prize was shrinking. The US faced a double blow: diplomatic deadlock and a rapidly electrifying China. The loss of the Chinese market was no longer a temporary setback, it was a permanent structural change. The US oil engine had stalled, and a reboot was nowhere in sight. The US-China oil split is a lesson in shifting global power, where economic ambition, rivalry, and technology collide. A once booming trade vanished overnight, as China rebuilt its supply chain and financial system around new partners and its own currency. American producers now face underused infrastructure and tougher competition in smaller markets, while China's EV push shrinks the global oil pie. The old playbook is obsolete. The US must navigate a world where its biggest customer is now its biggest rival. The future is uncertain. Will American oil find new buyers, or has the engine already stalled? What do you think? Can the US rebuild its export strategy, or is this the new normal for global energy? Thanks for watching. Subscribe to the channel for more updates.